Hey guys, welcome to the channel. Let's talk market structure. Market structure is a concept that is easy yet difficult at the same time. And many people tend to get it wrong a lot in the marketplace. But this ought not to be so, because market structure is the very foundation whereby your technical analysis, everything stands on. So you can't mess this up. You can't get this wrong. Now let's dive deep into what this is all about. What is market structure? In simple terms, market structure is the behavior, condition, and current flow of the market. Yes, it's that simple, yet complex at the same time. You might be asking, why should I even learn the concept of market structure? Can't we just move on without it? Well, market structure is the strongest foundation of technical analysis. Without it, what can you really do in the chart? Understanding the very simple, yet hard concept of market structure, which is the higher high, higher low, lower high, lower low, is contributing to 80% and even more to your profitability. Market structure illustrates who is in control, either the buyers or the sellers. Market structure is used to identify the trend, the major and the minor structures. You need these things to even analyze the chart. Lastly, understanding structure across different time frames is a whole new skill that is highly important. Market structure is the behavior, condition, and current flow of the market at a given time. Trend identification. The market is always buying up or selling down. There is never a stillness in the market, except in closed market or spread hours. The market is usually doing one of two things. The market can be trending, either an uptrend or a downtrend, or the market can be consolidating, can be called ranging, choppy, or unclear. Whenever you come to the chart, the first thing you should ask yourself is this market moving up? Is it moving down? Is it going sideways? Now, are you ready to learn how to identify all these types of market? Let's go. There are two characteristics of market structure, namely a trending market and a ranging market. A trending market can also be called an impulsive market, an expansion or distribution, while a ranging market can also be called consolidation and accumulation. What is a trending market? A trending market is when the market is moving impulsively in a trending manner. Ranging market, which can also be called an accumulation stage, is when the market is in its contraction moment. The buyers and the sellers, the same buying and selling power, so the market is literally just moving in a sideways direction, no trend, no nothing. That being said, let us move straight to the characteristics of a trending market. Now, there are two types of trending market. The first one is an uptrend. It can also be called a bullish market. And this is when the market is creating a series of higher highs and higher lows. It is when the market is breaking the highs and maintaining the lows. For example, you can see the market is creating higher high, higher low, higher high, higher low, higher high, higher low, higher high. We can say that this is an uptrending market. The second type of trending market is a downtrending market. It can also be called a bearish market. Now, this is when the market is creating a series of lower highs and lower lows. It is when the market is continuously breaking the lows and maintaining the highs, as you can see in these examples. It is breaking these lows and maintaining these highs. See, these are the strong highs and the weak lows. Breaking the lows and maintaining the highs. Now, in the downtrending market, the previous or the last low, in this case, let's say this low, should always break, while the previous high should not be broken. Because once it is broken, it is now like a change of character and it has the potential of changing trend. So yeah, the previous lows should always be broken while the previous highs should be maintained. A ranging market is when price is at its accumulation phase. It could also be called a consolidation stage or a contracting moment or a sideways market. It is one in which price bounces between specific highs and specific lows. The high price acts as a major resistance level in which price can't seem to break through. Likewise, the low price acts as a major support level in which price can seem to break through as well. This is a typical example of a ranging market. Price is moving in a sideways direction, in a sideways manner. Buyers are not in charge, sellers are not in charge as well. They have same strength in the market at this particular point. These highs are acting as resistance level and these lows are acting as support level. The price cannot seem to break off the highs and the lows. There are some people that have specific strategies to trade a ranging market, but generally we are advised to stay off markets like this because there's no direction, there's no volume. This is a typical example of an uptrending market. The market is creating a series of higher highs, higher lows, 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 and so on. In an uptrending market, remember that we said that the market is expected to break the highs and maintain the lows. See how the market is continuously breaking the highs and maintaining the lows. Breaking the highs, BOS means break of structure. So the market is continually breaking the highs and maintaining the lows, breaking the highs, maintaining the lows, breaking the highs, maintaining the lows, breaking the highs, maintaining the lows. Please note that an uptrend is only fully established when we have at least 2 higher highs and 2 higher lows. The market just basically change character. That does not mean that we would immediately start trading in the opposite direction. What that means is there's a potential that the trend could change, but it's not confirmed until in an uptrend it's at least 2 higher highs and 2 higher lows. Like we said, a downtrending market is when the market is creating a series of lower lows and lower highs. It is when the market is maintaining the highs and breaking the lows, maintaining the highs and breaking the lows consistently. Remember, we said a trend is not fully established. In this case now, a downtrend is not fully established until we have at least 2 lower lows and 2 lower highs. Then we can say that, okay, yeah, this market is in a downtrending mode. Whenever you see something like this, the market comes and breaks a high in a downtrending market. Some people will call it a change of character, which it rightly is. But that does not mean that this market is now bullish. It does not mean that, okay, you should now start selling. What that means is, okay, there's a possibility that this market could actually start trading upwards. But until that is confirmed by another higher high and another higher low, this market is still downtrending. The market is not bullish yet. This is what causes confusion in a lot of people. So make sure you note this. Notice how the market is breaking the lows and maintaining the highs, breaking the lows and maintaining the highs, breaking the lows and maintaining the highs. That's just typically what a downtrending market is. This is a visual example of a ranging market or a sideways market or a consolidating market. It's when the price is just moving in a sideways manner. There is no current trend at this particular point in time. This high is serving as a resistance and this low is serving as a support until market finally breaks out and gives a direction. This is a typical example of a ranging market. If you want to trade this kind of market, which I would advise you not to, what you can do is sell when the market gets to support and buy when it gets to resistance. But I wouldn't advise you to trade this kind of market. The trend is always your friend. Let's look at strong highs, weak highs, strong lows, weak lows. A strong high is a high that has broken structure to the downside and has created a new confirmed lower low, basically a lower high. And a strong low is a low that has broken structure to the upside and has created a new confirmed higher high. This is basically a higher low. If you don't understand that, hold on, I'll show you a chart example. A weak low is a low that hasn't caused any break or shift in structure, simply a lower low. And a weak high is a high that hasn't caused any break or shift in market structure, and this is simply a higher high. We trade against or away from the strong structure towards the weak one. In simple terms, this means that we buy the higher lows and target the higher highs, or we sell the lower highs and target the last lower lows. A strong structural point will cause a break of the previous structure, which makes it strong. Why? Because the financial institutions, they enter from there and they will likely protect that high or low. Hence, this is the reason we can also call the strong highs and strong lows protected highs and lows, as the big banks will not allow for price to go above or below because they will go into drawdown. But then remember, this is a theory, it's not a fact, it's not proven that is like this. That being said, let's look at some examples. By the way, guys, if you're looking for a broker to open a trading account with, I would recommend Exness. I've been using these guys for a very long time and everything about them is good, from their speed to their efficiency and reliability. Check the link in the description down below to get an account. The structural example of what we are talking about. This is a weak high, weak high, weak high, strong low, strong low, strong low. This is a protected low, a protected low, a protected strong low. This is an example of a strong high, strong high, strong high. You can see that these highs are being maintained because they are strong highs. Remember, we said that a strong high is basically a lower high. Like we discussed, we trade against the strong lows and trade towards the weak highs because they are likely to be broken. Same thing is applied when there is a strong high. We trade against the strong high and trade towards the weak lows because they are likely to be broken. I hope this is clear. Just to wrap up, a strong low is basically a higher low. A strong high is basically a lower high. A weak high is basically a higher high, and a weak low is basically a lower low. Major and minor structure. The main determinant of a major and a minor structure are time frames. Remember, price is the same. Time frames are just different representation of price, providing either less or more details. A major or a strong structure is found on the higher time frames. For me, higher time frame could be the 4-hour. For you, it might be the daily. For others, it could be 1 hour. The market is fractal. What that means is the same thing you see happen on the daily time frame will happen on the 1 minute time frame. And no, the 1 minute time frame is not noise. It's just a representation of more information and more data. The minor, internal, or complex structures is found on the middle time frames. Your major time frame could be the 4-hour and your minor time frame the 15-minute time frame. Still on major and minor structures, as you can see, this is a clear uptrending market on USD CAD. This is a clear 4-hour uptrending market. Now let's use this structural point as a case study. Let's mark it out. As you can see on the 4-hour time frame, we are uptrending. This is my major structure. This is a major structure because this is a 4-hour time frame. For me, it's a higher time frame. To you, it might be the daily, it might be the 1 hour, it can be anything. So this is the 4-hour time frame, and this is the major structure. Now let's go down to the 15-minute time frame. Let me show you how this correlates with each other. Here we are. Let me go ahead and delete this for clarity. As you can see, in the 4-hour time frame, we are in an uptrending market, right? But if you come down to the 15 minutes, what can you see? You can see that there is a shift in market structure. Now we are downtrending on the 15-minute time frame. What you do in this kind of situation is wait for the lower time frame to correspond with the higher time frame before you start executing. Always wait for the lower time frame to be in line with the higher time frame. Some people do counter trend trading and it works for them, but generally we are advised to wait for the lower time frame to align with the higher time frame, and that happened just here. If you're finding value so far, please do me a favor, like the video, subscribe to the channel, and let me know what your thoughts are in the comment section. Also, let me know if there is a video you want me to make in the future. That being said, let's continue with the lecture. Trend change. This signifies the first signs of a change of trend. Remember, it takes 2 higher highs and 2 higher lows to confirm an uptrending market. In an uptrend, it is the break of the last major higher low, the one that broke structure. In a downtrend, it is the break of the last major lower high, the one that broke structure. Do I use the body close or the wick as a break of market structure? I personally use the body closure. You can use the wicks or the body close as a break of market structure. MSS, that simply means market structure shift. Market structure shift is an indication that price may likely break the structural high or low. It is formed when a break of structure fails to form. This failure signals a shift in the order flow, indicating a reversal of an asset trend. Let's get to a drawing example of this. This is a visual representation of what we have been talking about. Please always remember that a trend is fully established after 2 highs and 2 lows are created, and vice versa if there's a need for that. This is what we've been talking about. If price does something like this, this is a potential trend change. But this downtrend is not confirmed until we have a lower low, lower high, lower low, lower high. Are we together on that? When market does something like this, until it confirms the trend by giving you at least 2 lows and 2 highs, just take it as though the market is in a ranging state and it's not clear yet. Wait for clarity before getting yourself involved in the chart. Market structure shift. Now, whenever price is uptrending and you see that it gives a low and fails to give another high, instead it creates a lower high and a lower low, it is an indication that price may likely break the structural low, in this case the higher low. Final thoughts. Please take it slowly, step by step. When you open a blank chart, it's probably all confusing. Do not get scared. Take your time, analyze the major structure, mark it up. Analyze the minor structure, mark it up. With time, practice and experience, your analysis can take you just 2 minutes. But for now, put in the time. You'll see trend changes everywhere. Are they all valid? Nope. It is generally advised to stay off the chart until a valid trend has been established. That way, you have a direction that you are trading towards. You have a direction that you're basing your analysis off of. The higher the time frame, the stronger the trend change. Remember that. Trend change on each time frame has a task. For example, 4 hour could be for your general direction, 15 minutes for your minor structure, and 1 minute for your entry alignment. That is that for this lecture. If you found value in these lessons, do me a favor, hit the subscribe button. Tell me what your thoughts are on the comment section and let me know if there is any video you would like me to make in the future. Bye guys.